Good afternoon, everyone. Good afternoon. Please, is my volume better now? Is my audio better? Good afternoon. Can we all hear me? Is my audio better? Can you hear me?
Yes, I can hear you.
All right. Okay. So we'll be starting right about now.
Yes, I can hear you.
All right. Thank you. So we'll be starting now. So we'll be starting now. Welcome to class. Thank you so much for joining. Everyone that is able to join in early on. We'll be beginning the session as soon as possible. But I would like to kindly ask that if it's possible, let us try to reach out to our co-mentees to just try to get them on the call too, so that we can have a full class. Please send reminders into your subgroups. You can repost the link into your subgroup and put a call through, right, so that we can have more people join in for the session. We'll soon be having our mentors join in, and I'm sure we'll be having quite an interesting class today. So good afternoon once again, and welcome to class. Welcome to week 4 of the JIIPCC Mentorship and Internship program for the FinTech industry class. And so far, it has been an amazing time within the fintech industry space. We've gone through week 1 to week 3, where we discussed in week 1 we discussed legal developments of fintech. In week 2 we discussed commercial developments of fintech. In week 3 we talked about business fintech business models, profit models, and fintech sector spread. So now in week 4 we are going to be talking about fintech contracts and transactions, and I hope you are excited for the session that we have put together for this particular class. Not to waste any time, I would like to introduce our mentors for today. So our first mentor for today, obviously is our one and only Mr. George Onyewuchi. Mr. George Onyewuchi has been with us from week 1 down to this very class. He will be joining us in this very class, and I will not be reading the full length of his profile. I'll just be reading, I think, the first few lines just to give him a brief introduction. So Mr. George currently heads fintech's engagements for First Banks and its subsidiaries across Africa at its digital innovation lab, setting up and driving the bank's fintech strategy. Like I said, just to give a little introduction to Mr. George, as we are already very familiar with him, and he has been a core part of our program for this particular quarter. So we a big thank you to Mr. George for everything that he has been doing so far for us within the knowledge he has been sharing within the period that we have been hosting this program. And our second mentor for today, who is already in class, is Mr. Max Ikombe. Mr. Max Ikombe was with us in week 1, where we talked about the legal developments of fintech, and he is here again in week 2 to help us trash the discourse on fintech transactions and contracts. Mr. Max is the founder slash principal of Everlaw Associates. He works extensively in the field of arbitration, ICT technology law, and intellectual property. Max is a facilitator on the annual Information Technology and the Law course of the Nigerian Institute of Advanced Legal Studies since 2016. He has trained he has trained in advanced intellectual property law courses at the World Intellectual Property Organization Academy, and is an accredited agent of the Nigerian Trademark and Patent Registry. He has conducted IP registration business there since 2010. Thank you so much, Mr. Max, for joining. We are happy to have you in class today. So not to waste any time, as we'll be going into the session proper now, we'll be taking presentations from Mr. Max, and as Mr. George comes in, maybe later on in the in the class, we'll be taking a presentation from him as well. But I want us That's for the mentees. I want us to get ready for our own presentation. We'll be taking the two groups presentation after Mr. Max is done with, his discourse into today's topic. So we would like to welcome Mr. Max. Thank you so much, sir, for joining us. We are happy to have you once again in class. Please, I would just like to hear from you in the next 25 to 30 minutes on your discourse on today's topic, FinTech transactions and contracts. You're welcome, sir.
Sorry, Dennis, just give me 2 minutes. My apologies. Just give me 2 minutes and get started.
All right, no problem. Thank you, sir. Okay, so Mr. Max will be will be with us shortly. I kindly ask that we exercise patience. Please, I would like to once again remind the mentees to help share reminders of this class in their subgroups so that we can start the class proper, or we can have a full class rather.
Yeah. Okay, hello. Can you hear me now, Dennis?
Yes, sir, we can hear you now.
Okay. Good afternoon, everyone. And as usual, I will start by thanking JIIPCC, including, of course, Dennis, Sophia, and all the other wonderful people who ensure that this JIIPCC program has been running non-stop now for, I guess, JIIPCC has run for over 5 years, maybe even closer to 6 or 7 years. So it's really commendable what JIIPCC is doing with this mentorship for program for young professionals who are coming into fields of practice that before now were not exactly things you will be able to find knowledge in the conventional schools and conventional places. So I want to commend JIIPCC and everyone behind that. I, of course, also want to commend my fellow mentors on the program. I'm particularly looking forward to hear Mr. George. I mean, I've listened to him before now, and I think every time I listen to him, he speaks from the viewpoint of a player in the industry who has a lot of experience. And I encourage the mentees, for people like that, you must always go the extra mile to really imbibe all that they say, because in it, you would find not just knowledge alone, but you also find wisdom. You also find the directions and the best way to track your career progression in this, what otherwise are novel fields of practice. And of course, I commend all the mentees. I've seen some of the presentations beforehand. I know it takes a lot of work to get those presentations ready, doing the research in addition to your other regular engagements, giving up prime time on Saturday to attend this program. But I can assure you it's well worth it. For me as a professional, when I started my practice, of course, I know a couple of us here are lawyers, and you know that law school does not prepare you for these kinds of things. So how I got into these areas of practice was through opportunities at programs like this, which in those days were few and far between, because those are the days before Zoom, where, I'm, of course, based in Abuja, and then I had to travel to Lagos every time I wanted to learn about these new areas of law. When WhatsApp came, I was fortunate enough in 2015 or 2016 to have joined a WhatsApp group then called Law Ethics and Practice. And part of what we devoted our time to do in that WhatsApp group was to look at futuristic areas of law and ask ourselves questions and try to learn more about it. So as early as 2015, we're already engaging things like blockchain, cryptocurrencies. Then Bitcoin was still quite kind of new, but we were doing a lot, discussing about it, bringing professionals from other parts of the world to speak to us. Then there was no Zoom, like I said. So we used to have what we call a WhatsApp seminar. So the person types all that he wants us to know on the group. We ask questions on the group and all of that. So it was quite an interesting experience and set me up to quickly understand some of these new areas and begin to leverage experience in that area. So that long introductory speech was just to encourage you, the mentees who have taken out time on a Saturday like this to join this session, that what you are doing, you are making serious investments. And I want to assure you from my own experience that those investments would pay off. So now going to the topic of the day, fintech transactions and contracts. My last session, if you remember, I tried to do a historical deep dive to say why, what is the justification for fintechs in the financial systems of the modern world. And if you can remember, I introduced you to certain concepts. We looked all the way back to the Great Depression in the US. We explained how the Great Depression happened, how a phenomenon called run on the bank, essentially when people lose confidence in banks and insist on taking all their money out, how that affected the banking system and led to regulations, and how because of regulations, operating a financial business became really cumbersome and expensive because of all the number of regulations you have to fulfill to be able to get a license to operate as a bank or allied financial services companies. And we now explain that because of that, I also introduced a term to you, which we called regulatory arbitrage, which essentially is a scenario where a person looks at regulations and says, how can I play in this sector without incurring the liability of complying with all those heavy regulations? So essentially, a person who is into regulatory arbitrage is looking at gaps between regulations and finding a way to create a business model along the line of those gaps so that it's able to offer those services without having to comply with those requirements. I gave some of the practical examples, including people who use money lenders license to do online lending, because the regular money lenders license is supposed to be a license that just allows a money lender operate in a locality. And the only people he has access to, the pool of customers he has access to, are people in that same locality who know him, who he knows. So it's supposed to be a small type of business that didn't have much of a huge reach. But you can see that because smart fintechs now saw that, look, we can start the business of lending on a large scale without having to incur the liability of getting a bank license. So how do we do it? We simply apply for a money lender's license, and then we use a mobile app and social media to now broadcast our services. And even though we are somewhere in Lagos, people from Maiduguri are able to lend money from us. People all the way from Sokoto lending money. People from Calabar are lending money. So you can see how that business model simply saw that there was a gap, because the money lenders regulation never said you cannot use the money lender's license for online lending. So you simply take that gap and say, well, if anybody arrests me, I say, well, I have a money lender's license, and there's nowhere in my money lender license it says I'm not authorized to do my business online. So you can see how through regulatory arbitrage, a fintech is able to expand its operations. So now coming to fintech transactions and contracts, that same mindset of innovation is also what drives transactions and contracts in the fintech sector. Banks also do transactions. Other financial institutions like capital market players, stockbrokers, and all also do transactions and contracts. But most of the transactions and contracts are very much more complicated because of the regulatory environment they're operating. But a fintech is able to carry out transactions, is able to carry out contracts more, in an innovative way, and therefore is able to do it more cost effective. So first of all, the first thing you need to note is that as an advisor or potential advisor to fintechs, you must always have that innovative mindset. You must always understand that the core reason why any fintech is engaging you is for you to be able to help them look at the regulations and find out the, what we call, in primary school, there's a word called LCM, lowest common, is it LCF? Sorry, lowest common factor. Yes, LCM, lowest common factor. So the idea is that if fintech is engaging you to help them look for the lowest common factor in any regulation, how can they benefit from playing in that field without incurring the liability of complying with all the regulations? So I'll give a practical example, for instance, using the same lending transaction. When a bank is lending, there are what they call prudential guidelines that banks must comply with before they can lend out money. So prudential guidelines have a lot of things. It tells them who you can lend money to, how much you can lend to the person, at what terms and conditions and all that. So a bank is not very free in a lending transaction. So in advising a bank in a lending transaction or drafting a lending contract, which is usually for a bank, a lot of documents, there will be an offer letter, there can be a term sheet, there can be what they call them, guarantee contracts and all of that, multiple contracts just for a simple transaction of lending. But with a fintech, because they are not under obligation, at least not all of them, to comply with central bank prudential guidelines, they are able to do lending business, lending transaction, and lending contracts in a more simple form. So bottom line, as a professional who wants to consult and advise fintechs, you must have that at the back of your mind, that when you are called into a transaction, you are not called to explore the complexities. You are called to look at the complexities, simplify them, break them down to a level where the fintech can engage in those transactions without having to incur those liabilities. Of course, like we also said last week, typically the fintech model also is a model of growth. So most fintechs start, with these low-level licenses, sometimes no license at all. But ultimately, they have to grow and then become licensed at some point and need to comply with those regulations. So for instance, we all know PiggyVest. PiggyVest started as a pure fintech. Initially, they operated, I think, only with a money lender's license. After a while, they moved on and obtained a microfinance bank single unit license. But recently, they have gone as far as obtaining a asset management license and all other kinds of licenses, even from the Securities and Exchange Commission. So you can see that also as a fintech advisor, you need to also understand that over time, fintechs, as their business models become more successful and all, the government is also not sleeping. The government is also beginning to iterate its regulations to, widen its net to catch them. Sometimes it's not the government really widening its net to catch them, but the fintech itself suddenly finds that, look, we have made enough money, we have enough experience now, want to play with the big boys. So they themselves are now putting themselves into business models that now require some of those, more complicated regulatory requirements. So that's just also to say that as a fintech advisor, you must broaden your mind that while you start small with that reductionist mindset of ensuring that as much as possible, I'm helping my clients, avoid the heavy duty regulations, but yet be able to run the business. A time comes where your role mutates to now advising them on, increasingly complying with those heightened regulations as they grow their business model and they gradually begin to get into the regulatory net as well. So this just shows that as a professional advising fintechs, your role is never, is never limited, it's never stopped. Your role is always, expanding and always on the increase. I think at this point, how many minutes I have, Dennis? I believe I had 15 minutes, and I think I've almost shot that. So maybe I should begin to wind down at this point, and then I look forward to the engagement to take more questions and engage more with you guys. So I'll end at this point, Dennis, and I'll wait to enjoy your presentations and also Mr. George's presentation. Thank you.
Okay, thank you so much, Mr. Max, for that wonderful introduction and discourse into today's topic. So what we'll be doing right now is that we'll be taking Mente's presentation as Mr. George is still not yet on the call. And then as we go on and as he joins in, we'll also get to hear from him and also get to listen more to Mr. Max. So please, if we have the group presenters in class, please, we would like to take your presentation right about now. Group 1, if you're with us, you have 15 minutes for your presentation. Kindly do well to share your slides and start your presentation.
Hello, good afternoon, everyone. Can you see my screen? Good afternoon, everyone.
Yeah, go on. We can see your screen. We can hear you well.
All right. My name is Dawala Ishamoninola, and I am the group presenter for Group 1. I'm the presenter for Group 1. And today's topic is...
Sorry, go back to the slide.
All right.
All right.
Can you see it now?
Better.
All right. Today's topic is blockchain and smart contracts in FinTech. So as we all know, FinTech is short for financial technology, and it has transformed the way we undergo financial transactions in today's world. While many attempts has been made in defining what FinTech is, there's no accepted definition of FinTech, and every definition usually covers and shows that FinTech enhances efficiency, it enhances accessibility and security through digital innovations like mobile banking, online payments, and blockchain. All right, that's just my introduction into the topic. I don't know why it is slowing down. Sorry, excuse me. Okay, I'm having problem moving my my slide, so I'm just going to continue anyway, and then send the presentation material to the group. Okay, so what exactly is FinTech transactions and contracts? FinTech transactions involve the use of innovative platforms to conduct digital financial activities, while FinTech contracts are those legally binding agreements that govern FinTech transactions so as to ensure strict compliance with regulations. Our topic today is blockchain, right? So moving on to the next slide, but I'm sorry, still having problems with it. We have seen where when we go to buy something from somebody's shop and you buy the thing on credit, we've seen that they document those purchases in a book, right? Especially amongst the older generations. Now, when those when the purchase is documented in a book, nobody can change those records unless the pages are either torn out or it is cancelled out. Now, imagine those books. Those books are copied and kept by 100 other people. Even if one person tries to cheat, it is already recorded everywhere. Exactly, that is how blockchain is. Blockchain is a program where every transaction is recorded permanently across multiple computers so that nobody can cheat, nobody can edit it, nobody can erase anything. Now, what are the key features of blockchain? Number one is that blockchain is decentralized. Traditional banks, when one is making transfers in traditional banks normally, a message can come and to just pop up and you see a service unavailable, or you see that or the transaction will just be delayed for no reason. The reason is your money is controlled by a single institution, and blockchain removes that centralized authority. So instead of one bank verifying your transactions, you have multiple computers in the network doing that. It makes transactions faster, it makes it cheaper, and it makes it even more secure. The second one is that it ensures that anything that you record, it ensures security, it enhances security, right? It ensures that anything recorded in the blockchain cannot just be altered. The third one is that it makes transactions faster. There's no need for you waiting on bank network for your transaction to get cleared. It just makes transactions very fast. Moving on to the next one, what is the purpose of blockchain in FinTech transactions? Number one is payments and remittances. Number two is smart contracts. Number three is fraud prevention and identity verification. Number four is decentralized finance. Now, let's be very honest. Banks they stress us a lot, from hidden charges to slow transactions to unnecessary delays when we are sending money home and abroad. But with blockchain, blockchain puts power back into our hands. So instead of having bank delays, instead of having bank transfer delays, alerts you receive alerts in seconds. Another thing is, while many Nigerians don't have bank accounts, they have phone, yeah. Blockchain-based wallets give them financial access without needing a bank. So the next one is smart contract. Smart contract is one of the most interesting financial innovations. Normally in traditional banks, in traditional contracts, we would have an agreement with so many grammar, stacks of paperwork, would have plenty stress, would have would have plenty grammar. And if somebody even tries to break this agreement, cut straight. So smart contracts removes all of that stress. They are self-executing contracts that are written in code. The moment both parties meet the terms of the contract automatically carries out the agreement. For example, your flight is delayed. Normally, the usual thing in Nigeria is that when your flight is delayed, forget about the money. After calling customer care 50 times, 100 times, you just have to forget about the money. But with smart contracts, your money is refunded almost automatically. Another instance is wanting to buy something online. Your money will be held in smart contracts and will only be released when you have received the item. Now, everything is all fancy, but who really regulates these smart contracts when there are no banks and no middlemen? The truth is, the government is still trying to figure that out. But in Nigeria, CBN oversees FinTech payments. We have SEC that regulates investment platforms. For example, for instance, now CBN has banned crypto, but it still supports blockchain for other financial uses. Sorry. The SEC also is working on rules for fintech investments, and there are data protection laws in place like the NDPR that ensures user information is safe. Globally, in some countries are fully embracing blockchain while others are skeptical about it. In the US, there is the OCC, that is the Office of the Controller of Currency, and the OCC handles fintech banking. One thing that is very sure, that is very certain, is that blockchain regulations will continue to evolve as blockchain grows. So obviously, everything that is good has something that is going to stop it, like a challenge, right? So for blockchain, the challenge is that people are always having complaints about their wallets being stolen, their crypto wallets being stolen. The reason is not because the blockchain was hacked. It was just because the companies using it had very weak security. That's why fintech companies need to invest in cybersecurity and AI to detect fraud before those kind of things happen. Many countries like Nigeria, don't have clear laws for blockchain. Also, just because a blockchain bank works in Nigeria doesn't mean it will work in the US. Although blockchain itself is safe, attacks can come from hackers when smart contracts are built poorly. So another important subtopic is cyber security. How safe exactly is fintech? Security is a huge concern in fintech, and the common threats usually include phishing scams. Phishing scams is when fake emails are created to trick users into sharing sensitive information about them. Second one is identity theft. We have hackers taking over fintech accounts. The third one is crypto wallet hacks. This is also a major problem. We have many people that lost their wallets to security breaches. Then moving on to how do we fix this? There's always solution to almost every problem. There's always a solution. So the first solution that is in place is extra layers of security like the MFA. That is the multi-factor authentication. We also have the AI-powered fraud detection, which is used in identifying suspicious activities in real time. And then lastly, we have blockchain security measures, which is used in making sure that transactions are tamper-proof. Fintech companies must stay ahead of cyber criminals by constantly upgrading security measures. Now, on to the next one. What exactly is the future for fintech? Fintech will continue to grow. With the times is changing. Fintech will continue to grow. And we're already seeing exciting innovations like the quantum cryptography. The quantum cryptography, which is a super secure encryption powered by quantum computing. We've also seen decentralized identity, where users use their own, where users own their digital identities. And the third one is AI in FinTech, where machine learning helps prevent fraud and automate decisions. In conclusion, blockchain has changed and is changing the way we transact. It is faster, it is transparent, it is decentralized and secure. Smart contracts are making financial agreements faster, making it cheaper, making it more reliable with no middlemen needed. While these technologies provide efficiency and security, regulatory compliance and security are crucial to ensure trust and long-term sustainability of these platforms. So data protection, privacy laws, ensuring consumer protection in FinTech must be put in place, and a good data privacy and a good privacy policy must be transparent, must be easily accessible, and must provide the users their right to access, modify, and delete their data. Thank you. That's all from me.
All right, thank you very much, Aisha, for that presentation from you and your group. Please, you can stop sharing your screen. All right. Okay, so please, can we have Group 2's presentation? Group 2, presenter for Group 2, please, you can kindly share your slides and also start the presentation.
Good afternoon. Good
Yes,
afternoon, everyone.
Good afternoon, Sonia.
My name is Sonia Obianujosita, and today I'll be presenting on FinTech transaction scalability and efficiency. This presentation will explore how FinTech companies can scale transactions efficiently, the challenges they face, and the solutions that can enhance operational efficiency. This is a very important topic as FinTech sector continues to evolve rapidly. So first, I'm going to define what we mean by scalability and efficiency in FinTech. Scalability refers to a system's ability to handle increased transaction volumes and user growth without compromising performance or security. Efficiency, on the other hand, is about optimizing resources to ensure smooth operations. And there are some examples of scalable and efficient FinTech solutions. They include blockchain technology, which allows fast and decentralized transactions. The second one is cloud-based payment systems like Stripe and PayPal, which enable seamless processing at scale. And the third one is AI machine learning, which improve fraud detection and customer service. And lastly, mobile payment systems such as Apple Pay and Google Pay, which offer fast and convenient transactions. Now, why does this matter? Like, we're going to talking about the importance of scalability and efficiency. FinTech companies need scalability and efficiency to support growth, enhance customers' experience, and remain competitive in the market. Without these, they may face issues like slow transactions, high operational costs, and security risks. For example, if a FinTech platform cannot scale properly, it may crash during peak periods, leading to customer dissatisfaction and potential revenue loss. Therefore, scalability and efficiency are not just nice to have. These are like essential for success. So the next one is the challenges in Nigeria's FinTech sector. Despite the rapid growth of FinTech in Nigeria, there are several challenges limiting scalability and efficiency. Number one is cybersecurity threats. Nigeria ranks among the top 3 African countries for cyber attacks. FinTech platforms face risks like phishing, ransomware, and API breaches. In 2024, ransomware attacks cost an average of 1.2 billion per incident. And the second one is infrastructure deficits. Only 40% of Nigerian adults use formal financial services. Limited broadband access and unstable power supply make digital transactions very difficult. And the third one is payment gateway limitations. Despite innovations from companies like Flutterwave and Paystack, network downtime still cause transaction failures, affecting platforms that handle millions of transactions daily. So how does this payment processing work? Please, can you still see my slides?
Yes, we can. Please go ahead.
Okay, thank you. So how does this payment processing work? There are several steps that are involved. The first one is initiation. A customer provides payment details. And the second one is encryption and transmission. The data is securely sent to a payment gateway. And the third one is authorization. Here, the bank verifies and approves or rejects the transaction entirely. And then the fourth one is clearing. Under this clearing, funds are transferred between banks. And the fifth one is settlement. Here, the business receives the money. And then the sixth one is reconciliation. What happens here is that the transaction is now recorded and then verified. Each of these steps ensure that transactions are processed accurately and securely, thereby making fintech transactions reliable and efficient. So now, to overcome these challenges and improve scalability, fintech companies must adopt strategic measures. So here I'm going to be talking about the strategies for scalability and efficiency. Number one, resource allocation. Scaling requires investment in capital, technology, and skilled manpower. And number two, continuous improvement, like regular updates, performance testing, and quality assurance. They also help to maintain efficiency. And number three is user retention. We're going to personalize services and loyalty programs, keep the customers engaged. And number four is cloud infrastructure, like using platforms like AWS and Microsoft Azure allow for flexible and cost-effective scaling. These strategies here enables fintech to grow without compromising performance. And another way to improve efficiency in fintech transactions are through contract automation. And there are tools that help, like by automating payment processing to reduce manual errors. The second one is centralizing contract data for easy tracking and compliance. And the third one is sending automated reminders so as to prevent mixed payments. By automating these processes, fintech companies can improve speed. They can also improve accuracy and operational efficiency. So here we're going to be talking about technologies for this automation. There are various technologies that support contract automation, and they include ERP software for managing contracts and financial transactions. Second one is robotic process automation. They help to handle repetitive tasks. And the third one is AI and machine learning, which analyze contracts and also identify risk. And the fourth one is cloud computing, which enables scalability and remote accessibility. These tools help fintech operate more efficiently and reduce cost. In conclusion, for fintech companies to scale successfully, they must invest in the right technology. They must also ensure security and focus on efficiency. Also, forming these strategic partnerships with established financial institutions and banking as a service providers can expand their reach and enhance credibility. The fintech industry is evolving rapidly, and by implementing these strategies, companies can stand ahead in the competitive landscape. Thank you.
All right. Thank you so much, Sonia, for the presentation from you. Well done to both groups, that is Group 1 and Group 2, for such comprehensive presentation. And also, it was very quick and fast. So well done, and please keep up the good work. All right, we have Mr. George in class. Thank you so much, sir, for joining. We would want to give the floor to you, sir, for your discourse on the program and also feedback to the presentation. And then we'll have feedback from Mr. Max, and then we'll take questions, and that will be that for today. So Mr. George, sir, do you have any discourse for us in today's class?
Hi, good afternoon, guys. Am I audible? Can you hear me?
Yes, sir, we can hear you.
Oh, okay. So the topic for today, because I think the presentation, I think the second presentation, I think I came in just at the end of the first presentation, and then some part of the second presentation too. But I don't know if it was the same exact topic that they were speaking to. You want to help me on the topic for today? Is it the blockchain smart contract one, or something around the fintech efficiency, or something around that that she
Okay,
talked
so
about?
our topic for today overall is fintech contracts and transactions.
Oh, okay, okay. Fintech contract and transaction, right?
Yes, sir.
Oh, okay, okay. Is that the part where there's a subset of it that is speaking to um, smart contracts, blockchain smart contracts?
Yes, sir. Under that, we give them subtopics to research under, which
Oh,
includes smart
okay,
contracts and
okay,
blockchain.
okay. Oh, I get it now. Okay, thanks for the context. All right. Good afternoon, everybody, and apologies I got in late. Weekends are increasingly becoming very tricky, trickier for me. Um, I mean, as always, before I come into the presentation side, I just want to make a quick comment. I trust that the earlier mentor has most definitely done some justice to the topic of the day. So I'll definitely not take a lot of our time. If we look at the topic, fintech transactions and contract, and then broken down into the fintech side and of course the blockchain side, looking at smart contracts, right? And then contracts and transactions on the Web2, what we call traditional fintech side of things. It's just to even start by saying what really differentiates both divide, right? What really is that difference between smart contracts and um, regular fintech transactions, right? While looking at the entire topic around fintech transactions and contract. As we all know, contract is like an agreement between A and B, or among A, B, C, and others, right? Basically, a way of formally agreeing, right, to some specific terms, right, under which exchange of value and exchange of some form of value is agreed, right? That value can be money, that value can be something else, right? But it's just an official way where an agreement is reached, right, between the parties involved, right, on how and in what form or nature that a particular thing is going to operate, right, and how value is going to exchange, right. And when you bring it into the fintech transaction world, right, it's basically a legal agreement on how value will be exchanged, right, for money, right, for the most part, right. Um, Contracts and transactions, when you look at it in the context of transactions, right, is basically how we are going to be able to give value in exchange for whatever it is that the cost of that value will be, right, and other on the underlying um, under underlying terms, right, and conditions for which that transaction will take place. Now, the major difference with
Traditional
around
contracts,
around transactions,
transactions.
hearing myself,
Yeah.
for this, the major difference
The
around
major
those
difference
two,
around,
I don't know if it's echo. I don't know. Maybe
I don't know, maybe
someone can mute if they are not
they are not,
talking. I think it's
I
echoing
think it's
somewhere.
echoing somewhere.
Dennis, I don't know if you can help mute. Yeah, thank you. All right. So is that when it comes to blockchain smart contracts, unlike traditional contracts that can be susceptible to changes, right? When I agree with you on the basis of the transaction, there's possibility that someone can go change the contract terms tomorrow, right? And what I ordered versus what I got, situation would happen, right? But when it comes to smart contracts powered by blockchain technology or Web3 technology, you can't change contract terms. You can change the smart contract once it's executed, right? You can only do another smart contract to overwrite that, right? Or you take that offline. But once you execute a contract, you can't change it. It is immutable, right? And that is one of these very strong thing around smart contract. It's also self-executing, right? These two critical features are the two features that make smart contracts, kind of have the value that they have, right? When it comes to using blockchain technology to power financial transactions, right? They're self-executing in the sense that they don't need a third person, they don't need an arbitrator, they don't need a system or anybody, right, to have to execute them, to trigger them. So if I agree that at the end of this particular transaction cycle, or at the end of this, if I do this, you're going to give me Y, right? If I'm able to finish reading or watching this video, right? At the end of this video, once I watch this video, you're going to give me 100 naira, right? For watching this video, right? Or you're going to give me at the end of having this conversation here today, this class, JIIPCC is going to give me 100 naira, right, for having this session and talking to people in this session. Once we agree that, right, and execute it as a smart contract, it is self-executing in the sense that it is done in such a way that at the end of the class, I don't need to remind JIPC, Gypsy, to pay me 100 naira. I don't need Gypsy to even do anything within themselves to pay me 100 naira. At the end of the class, the contract is going to execute itself, right? Once we put all the necessary parameters that shows that I have met what we have agreed on, right? Those parameters will trigger the self-executing nature of the smart contract to pay me 100 naira. And there's nothing Gypsy can do to stop that execution, right? So I'm not in the mercy of Gypsy, to get my 100 naira after I've delivered value. So you don't have those situations where a contractor has delivered value and is literally chasing you every day to collect their monies, for the value that they've delivered. So it's one set of work delivering the value, then it's another special set of work trying to even get paid for value that somebody has delivered to you. But once such contracts are executed on the blockchain using smart contracts, you don't need to chase anyone to get that money paid for you for the value. Once you meet the necessary parameters, the things that show that you have delivered that value, the contract executes and transfers that money from the pocket or wallet or account of the guys that is supposed to pay you that money, and you get your money, right? So the special nature of that self-executing feature of smart contract, and knowing that it is immutable, that means nobody can go behind you and go and change the conditions of that contract once it is executed, right? Your beneficiaries, the guys that you're contracted to, cannot go behind you to change those terms like they can typically do today, and then you guys start arguing and go to court, right? In this situation, they don't have that opportunity to change that small contract terms, right, from executing. So it's immutable. The only thing they can do is that you can now have another new smart contract that would, overall what the existing one was, right? So, but they can't change the existing contract terms, the way it has been executed. So it is that immutability of it. It is that nature of it to self-execute without allowing anybody or being on the mercy of anybody that makes smart contracts very appealing, right, and very special, and one of the features or benefits, right, of using blockchain smart contracts. While unlike in the traditional fintech contracting, you have a situation where you feel that you've been cheated, and then you go to court and somebody tells you, but it's in your terms and conditions, and you didn't read it, because during when they say terms and conditions, right, they probably give you 5,000 pages. All of us, we all do it now. All of us will just scroll to the end and click, okay, I agree. None of us reads any of those fine text or those fine lines. Just click, I agree, right, and move on. And then tomorrow they'll tell you, this is what is in the contract, it is the terms and conditions for this service that you've agreed. So it is not as transparent. It is not as and there's control from the party that is setting up or that manages the terms of such relationship. Unlike here, where everybody has equal dependencies on the system, right? On this other side, those contract terms are basically controlled by the party, that is actually serving the that's actually presenting the services. So when it comes to financial transaction contracting in the traditional world, while it also has its merits, right? The smart contract also have some merits, over it. But generally, this is the major divide, right? Or the major thing outside the core technology, right? That differentiates it from themselves. Right? Then talking about financial transactions generally in the fintech space, whether it's blockchain, whether it's Web 2, what we call Web 2, the traditional fintech world. One thing that we should also understand is that the nature, right, and the need, right, and the value for that entire process remains the same. Somebody wants value, and that is why they engage in transactions. Whether you're using the blockchain technology or whether you're using a typical Web2 technology to carry out that transaction, it doesn't change the value that the person wants from that transaction, right? And the expectation wanted from that transaction, and the promises that you have made, right, that needs to be delivered. If I want to pay for something and you're a payment gateway and you're supposed to collect my card information, right, and process that payment so that I can get value from the website that I'm buying from. I'm buying something from Amazon and I want to pay for my books, books I'm buying from Amazon, and then you're a gateway that is processing the money I'm paying to Amazon, right? Whether that gateway you're providing that service with the normal traditional rails, whether you're providing it through the blockchain technology, it doesn't change my expectation, right, of the service that I'm I'm expecting to be delivered to me. That my money should be processed, quickly, seamlessly, right, so that I can get value from the merchant I'm buying from, and the merchant is expecting that money that has been processed from customer is given or settled to it conveniently so that they can confirm they've received that money and release products, right, to the customer, right? So that is kind of what the expectation is. Now, the expectation does not change because of the technology that you've used. The technology is just the different ways that you want to meet, right, that expectation. So on a higher level, the nature of fintech transactions, right, remain the same across board, right, regardless of the technology that we use to put to it. And it's one of the confusions a lot of people have about blockchain, right? And you see a lot of people go too sexy about the technology and forget that it is not about the technology, it's what you're using the technology to do. It is not enough to say, doing X in the blockchain space. I have a blockchain fintech, right, that is doing blah, 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 blah. And then when it comes to actually delivering value, right, it's not able to deliver the value. The customer doesn't care that you're doing blockchain technology. The customer wants value for what you have promised that your system or your platform, is able to do. Whether you're using Web 5 to do it, whether you're using Web 1 to do it, the customer cares less. It is just how you feel that you'll be able to efficiently deliver value to the customer. Lastly, just to touch point on you as the fintech, right? And then you from the legal perspective or the legal point of view, right? If you're advising a fintech or you're with the fintech, depending on whether the fintech is on the blockchain space, depending on whether the fintech is played in a traditional space, right? There's some key things that you want to make sure that such person is very conscious about in financial transactions, right? When it comes to financial fintech transactions, right, naturally the system, the regulatory system and framework is first of all, for the customer, right? So it means that in any dispute or in anything that happens between you and the customer, the system or the law or the regulators are already first. The customer has already warned you before you prove otherwise. Let me put it in the lamest way we can get it, right? Because it's always believed that you're the big guy, wanting to oppress the small guy, right? The small guy comes, is expecting that X, Y to be done for him, right? Whatever happens in that whole chain is your responsibility as a fintech to ensure that this guy is protected, right? And this guy gets value for what he's trying to do. So as you as a legal person, you want to be able to advise a fintech on how they can make sure that they are well protected and they protect the customers, because whatever happened in the course of that transaction, regardless of if it's the customer's fault, most of the time they still bear that responsibility. So it is why you see the banks or the fintechs try to tell you how to protect yourself, how not to share your password, how not to allow people to take your PIN, right? How not to do this or how not to do that, because they have a liability to still protect you regardless of the fact that you have responsibility to protect yourself. They have the liability to make sure that even in an event where for some reasons you were careless and somebody gets your PIN, there's mechanism they've put in place, right, to manage the damage that will come on you for someone accessing your account, for example, without authorization, even though they have your PIN. There's an expectation that their system in some kind of way should be able to minimize that damage, right? Detect the fraud and minimize that damage. So from you as your own perspective as a legal person, you're looking at what are the things that in financial transaction is sensitive to ensure that the contract between the person that is about doing that transaction and the fintech protects both of them, whether it's from the data side of things, right? Data is a big deal, right? My information that I'm putting on your platform to process a transaction, is it protected? Is it safe, right? Is it making sure that it's not going into the wrong hands? Is it going to be used for other purposes other than what I'm giving you to use it to process a transaction? Are you going to turn it into a marketing tool, sell it to marketing companies? So what are the protection you have on that guy's data that is given to you so that you can help him process a transaction? Whether it's on the part of his privacy, right? His whether it's on the part of his security. How are you, putting measures to secure that transaction, so that somebody does not either intrude into that transaction, or in some way or the other that transaction happens securely and safely. And if anything happens, you are able to get either it's a backup or in some way or the other protect the guy. So what is the security that you put in place? What is in the agreement of that transaction? Now, all these most of the time are embodied into T&C. That is why you see that T&C is always very long, right? Because if you go into any T&C, right, terms and conditions, when you want to process any transaction, you will always see that there are so many information broken down in parts. What they will do on private security, what they will do on disaster, what the one that they are liable for, what they will do on if there's an intrusion, your responsibility, people that have access to your data, where you have failed transactions, right? You will see all the various things in that T&C. So your responsibility as a legal person is how do you make sure that that T&C is properly captured and scripted, right, to cover the company, right, and also make sure that it also brings transparency to the customer, right, on what they are liable for, on what they are responsible for. But because even if they say I agree, right, it would not still make you not liable. You're much more focused to make sure that the actual experience that the guy is having, that you're also putting more effort to secure that transaction and make it seamless, regardless of what is in the contract that the person has signed, right? Via the T and C's, right? Same way in blockchain side, that part is not really too heavy because once you embed all those things within the smart contract executes itself. Smart contract takes care, the blockchain technology takes care of a lot of things around there. So there's really a need for third party interventions, right? But if you're dealing on the traditional side of things, it is your responsibility to make sure that the fintech itself, beyond contracting, beyond whatever they put in T&C, beyond whatever you have on paper, you're actually going beyond that to ensure that you protect and ensure that that transaction happens smoothly, because ultimately you are liable with when it comes to regulators on whatever happens in that transaction. So there's a mindset that we need to always understand that it is you, the big guy, always going to be the guy that will take the fall, more than the customers at any situation or any point in time. So protection of the customers must be your topmost responsibility, even if you still, put the necessary things, information in the terms and condition or in any other kind of contractual document, right? That you're going to make the guy sign. I think that's like one of the things I just wanted to highlight while we are discussing fintech transactions and contracts, and looking at it from both the traditional side, right, and the blockchain side of things. So I think any other thing we'll take it in the Q&A section. And lastly, on the presentation, good presentation, especially for the second one that I saw, pretty much um, interesting details. It showed that some work has been done on the presentation, right? Part of the beauty of doing this presentation is the information that you consume, right? While the learning actually happens while you're researching for the presentation, right? More than even when you actually put the slides together and say them here. It is actually in the team when you're researching to get all the information that you now synthesize to bring out on your slide. So good effort by the team, right? I always keep saying, find a way to communicate your messages using relatable examples. Find a way to situate the context of your message within our environment, right? But ultimately, well done to all the mentees that have been involved in those presentations today, as we discuss further during the Q&A. Thank you.
All right, thank you so much, Mr. George, for that discourse from you, and also, your take on the presentation. Mr. Max, if you're still with us, sir, we would also want to get feedback from you, and just generally for you to highlight any points you would like to share with the mentees. We are welcome, sir. Mr. Max.
Dennis, please, I'll beg for another 3 minutes. I need to quickly make a payment.
Oh, all
Just
right.
give me back to you.
So while we're waiting for Mr. Max to join us again, right, for his feedback, we would want to start taking questions, right? So if there are any questions, you can share your questions in the chat box, and we will do all to take your questions. So please, do we have questions for our mentors in today's class? Do we have questions? I really, really want to encourage us to ask questions. Okay. Oluwadamilola, please, you can go ahead and ask your question.
Oh, hello everyone. Good afternoon. Thank you for your time, Mr. George. It was really insightful. And thank you for the presentation. I have two questions. So I listened to the bit where you mentioned that, as compliance regulators and everything, we really have to wrap our head around it and, aggregate business needs and everything. My question is this. Yesterday, the Investment Securities Act by the president, uh, President Bola Ahmed Tinubu was signed into law really 2024 and all that. And I think one key thing that I noticed was it redefines the investment security tribunals, and then it gives a bit of insight towards fintech, because originally there was a bit of gray area, because as we said earlier in one of our previous classes, that as compliance in fintech businesses generally, financial technology, they tend to be a bit of gray area, so you just hold on for a while. But now there's the whole digital asset class, there's the whole, going forward, do you think this would increase the cost of compliance generally? That's my first question in relation to that. And then my second question in relation to that is you know especially given, okay, okay, especially given your background in finance and everything, with the whole investment securities tribunal, is it something that should be a cause of worry for businesses? Because it's supposed to be something that's, it's an enforcement part of the Security and Exchange, the SEC in general. But like, now that they've given them a bit more power, is it possible that they would be, a bit more involved in place of the usual system where the SEC would come first, and then, because you know, it's a bit of fast track. It's a bit there's a section that sort of fast tracks it a bit. Yeah, those are my two questions in relation to that. So I'll just hold on for the next part.
All right. You need me to take that, right? Before you ask the other part, right? So you can hear me, right? I hope I'm audible.
Yes, sir, we can hear
Yes,
you.
yes, I can hear you.
Okay. All right, that's fine. Now the good question though. The Investment and Securities Act, which was just passed, I think it was yesterday. The thing about that act is that before now, one of the major things that act sought to deal with, right, is how much Ponzi schemes, right, all in the name of investments, has been proliferated, right, and people just set up and announce investment scheme unguarded, right, and it's why a lot of people have fallen into the trap of investing in Ponzi schemes. Most of the time, you don't even know, except maybe you read in between the lines, when an investment is real, right, by a licensed person, or even an unlicensed person but has an extended license, by a broker or somebody licensed or regulated within the um, um, SEC and these regulatory entities, right? People just, you can wake up tomorrow now and Gypsy will say, Gypsy cash for learning, right? Learn 2 slides, right? Pay 500, take 2 lessons, get 5,000, and you be wondering what is the fundamentals for this so-called learn for cash investment, right? So people just wake up and just launch so-called investment opportunities unguarded, right? And no scrutiny, no prerequisite control or approvals by the regulatory guys, right? People just do things in how they want. So basically, a lot of it is really to scrutinize, how much freedom we have in just shooting out different so-called investment opportunities. So it's significantly targeted, apart from some other things they try to use to clean up the industry, setting up the tribunal, the securities and investment tribunals, like empowering it to be independent, right? So that it can give stiffer punishment and stiffer fines, right, for defaulters. So kind of empowering the tribunal that oversees legal related issues when it comes to securities and investment, right? So some other industry things that were really done, but a lot of focus in that thing is targeted at really putting sanity, right, in that whole quick investment space, especially for people throwing out, carrying, leveraging that the fact that it's unregulated and Ponzi schemes are becoming the order of the day. Right. So for us, I mean, it's really nothing unusual, right? If you're not doing the wrong thing, it's just for you to seek. If you cannot get licensed, if you cannot register your investment scheme under the regulatory framework that they provided, right? Under the and maybe become also be a legal entity, identifiers, right? That they have also created. You can find partners that are within the framework, that meets the framework, and partner with them to launch your investment opportunities. Also, they try to monitor how funds are flowing. Some people are carrying out a lot of fraudulent what they call that now, laundering, right? Some people are using investments to launder money, right? So part of also what that thing try to do is also kind of regulate and monitor the flow of funds from investment vehicles, right? A lot of people use investment vehicles to launder money, and they will claim that those monies that people have paid into the scheme for as investments, right? And but those monies are actually monies that are fraudulently gotten and being laundered using those investment vehicles. So there's a lot of monitoring within that framework, right, to follow the money, basically how monies flow, right, within various investment schemes, right, and various investment vehicles. So it's basically just trying to sanitize that whole thing. If you're doing the right thing, it isn't much of a worry. It's just that there is now much more scrutiny. So you have to be sure that at least there's some part of that framework that is covering whatever investment opportunity you're doing, or you're partnering with somebody that is within the compliance of that framework, so that the person can cover whatever it is you're doing through that extended partnership or extended licensing. I don't know if that helps clarify your question.
Yes, it does. Thank you. Thank you. The second bit, so I mean, consequently, means cost of compliance should go up, right?
Naturally, compliance is not cheap. Um, it is why it is why most times at the beginning of the journey of most fintechs, right, you are likely or unlikely to be fully compliant. Very unlikely. Like we always say, innovation will always precede regulation. So compliance is never cheap, um, and it hasn't gotten any cheaper, right? But the truth is, um, it is it is better safe than sorry when it comes to the regulators, how they are seeing this thing. It is better that there's an extra step to comply, even if it makes it a little bit more expensive, than the system crashes because on looking Nigerians, or how they say that, or many Nigerians lose money, to a potential Ponzi scheme. Or sometimes it might not even be a Ponzi scheme. It might actually be an investment, a well-meaning investment, but that just goes wrong because the people involved in bringing out such investment opportunity have not done their due diligence, have not done their homework, and the promises they are making are not realistic. It's not like maybe they actually set out to run a Ponzi scheme, but they just realized that they actually made unrealistic promises, right? That and the investment opportunity actually genuinely actually swallowed the money, right? Or sometimes it's risks that people can mitigate, but they will take those risks because they want to get big rewards. You get so all those kind of things. If somebody gives you money for something else, for investment, maybe farm produce, or just the way you're putting your money in piggy vest, right? You're putting your money in piggy vest, then piggy vest takes your money and go and invest it in risky investment opportunity. You don't know what they're doing with your money that you're putting in PiggyVest, right? So, but they are responsible to take that money and put it in moderately risky investments that are not too risky, so that your own money, your own depositor fund is not at risk. So if the compliance cost has to increase to make sure that such persons like PiggyVest, for example, any other guy that has access to your monies, to depositors' funds and want to put it into investments that can actually make them lose their money, then it has to be what it has to be. There's a huge responsibility for that liability you're taking. You're taking people's money. It's a huge responsibility that they don't believe that the cost of compliance should be a reason why you should not be compliant when you're actually taking people's money and putting people's money at risk. Do you get me?
Yes, yes, I did. Thank you. My final question is, in regards with, because thank you so much, really. It was really clear and I understood what you meant with their whole intention and everything. My final question is regarding the digital asset class, because the this thing is it's very clear. It talks about this virtual asset service provider people, digital, this I think it's looking at cryptocurrency, the e-naira, all those people and everything. My question really is, if I want to advise someone who, because in Nigeria now there's this rise whereby, an aspect of fintech. I don't know if well, I don't know. I think it's a bit overlooked is cryptocurrency, quote and unquote, forex traders, quote and all those NFT people, just generate those class of people. Now that they've been covered, if someone comes to meet me for, legal insight on that kind of thing, would it be safe to, generally provide some the earlier template of fintech legal advice where we have to now aggregate the whole service bit? Because I feel like it may be a bit different given the fact that a lot of cryptocurrency platforms are not based in Nigeria. And now that the SEC has sort of tried to cover them, I don't know, I think there's a bit of overlapping oversight, such that if someone comes to give me, you know, issues and they're asking questions about their investments in, say, maybe Binance as a trading platform, and then the cryptocurrency is one of these lower known cryptocurrencies. I think there's, like, for instance, maybe Trump coin or meme coins or something. I wouldn't really know what to say, and generally I've avoided this because Nigeria doesn't even recognize it outside of the. But now that they've actually provided for it under virtual asset service providers, digital asset operators.
I don't know if it's me, but it looks like your network is cutting out at some time. Like there's a bit of in and out. I don't know if it's from my end or from
I'm
your own
sorry.
end.
Did you hear the bit about the virtual assets providers and cryptocurrency?
Yes, but it was in and out. There's a part where you say you didn't know the advice to give when someone comes to ask you
Yes, because generally
about.
cryptocurrency doesn't, in Nigerian legislation, it's not entirely recognized as a form of, how do I put this? Because of most of these cryptocurrency, these coins, they're generated outside of Nigeria. So you can't entirely sue them in Nigeria or anything. But now that the SEC regulators has come out to say, okay, these are what we're calling them, these are what they are, we now have Nigerian minting companies. Does this not give room for us to then, use the financial tech approach, or would we have to come up with a new different approach? I think that's just the aggregate, the sum of what I'm trying to
So,
ask.
so the truth is that these are early days, right? These are early days. How this, there's one thing to have a law. There's another thing to how you interpret that law, and sometimes two people interpret the law in slightly two different ways, right? There's the letter of the law and there's the spirit of the law. So sometimes the letter of the law is saying do this and do X, but someone will tell you that the spirit of the law, that you can actually do X with a little bit of Y, right? Because what the law intends to achieve when they said you should do X is that it wants everybody, right, to probably get to Z. And doing X with a little bit of Y has helped everybody to get to Z, which is what the law intended to achieve with the letter of the law saying do X. But I didn't do X, I did X with a little bit of Y. I tweaked it a bit, and I'm making the case that I'm still in the same spirit of that law, which is to make everybody come to Z. I have helped achieve what the law intended to achieve, right, by saying do X. So it is early days, right? A lot of us at this time is looking at how this will be interpreted, right, and how this will be um, executed, in the sense that when you look at cryptocurrencies, in fact, I'm actually going to be, it's actually a place I'm actually active in, and there's also something I want to do soon. I think I have my the series. I'm doing a series of live sessions on it. I have one starting. I think it's April 8th, right? And after it, I'm planning to do something. There's been a lot of noise in the space, and a lot of people that are not in the space, I'm sure just wondering this whole cryptocurrency, this whole blockchain, how do I investment or whatever? How do we even do it? How do we even go from hearing this thing in the air to actually doing it in real life and actually, you know, earning, the so-called dollars that you can actually withdraw and spend, right? And I like, you know what, this whole thing has been in the air for a lot of people. Let's make it real. Let's do probably a 30-day, 60-day challenge that will take people from, hearing this thing in the air and not having a clue how to go about this to actually, you know getting into their first cryptocurrency investment and making their first cryptocurrency dollar, right, in the space. Right? It's something I'm going to do, pretty much. So probably launch that on the 8th, right? But outside that, where I'm going to is that this whole space of cryptocurrencies has been looked at in different ways by different regulators. SEC, right, has been very strong around seeing um, creating raising funds using crypto, right, by launching coins, right. A lot of people will launch their own coins and do their ICO, right, their coin offering, and raise money, right. You create a meme coin today, right, is an investment asset, because people will now put money to buy that meme coin and hold it, right, so that it will appreciate. So it has become an investment too, right? But you're doing it today without anybody regulating it, right? And SEC is saying, no way, you can't, out of your own. You wake up in the morning from your bed, you just create an investment asset. Just create a virtual asset class, create a coin, and people are supposed to start giving you money, trading that coin, right? And they don't have a hand and oversight around what you're doing, right? How you're taking people's money, right? And what you're doing with it. So you're just generating money out of the blues, right, on your own. So what they try to do is to look at what are the lines, what are the kinds of assets that you can create, right? At what with what kind of license, or with what kind of approvals, right? So they try to look at these various asset class and say, hey, you can do this, but for you to be able to do this, these are the conditions you must meet, right? You can do X, these are the conditions you must meet. So if you create a coin as a digital asset, right, some will argue that it is not an asset, right? It's a transactional tool. It is not for investment. It's a way of exchanging, especially tokens. It's a way of exchanging value within a particular blockchain ecosystem. And some people say no, right? You're going to launch that token, right? You're going to maybe do an ICO, an initial coin offering for people to buy the tokens, right? So it's also an investment asset. At the same time, it's also a transactional means of exchange. So sometimes is a divide between, is it a means of exchange or is it an investment, right? Are we using these coins to pay for something in that particular blockchain network, or is it an investment tool that somebody is holding and waiting for it to appreciate, to sell, right? Some of these things have dual characteristics. They are both investment assets, right? And at the same time, they are also a mix of exchange. Bitcoin is a currency that you can use to buy something from a platform, right? But at the same time, Bitcoin has become, even though it was unintended, but has become an investment asset. People now buy and hold Bitcoins for it to appreciate. People trade Bitcoins as an investment for it to appreciate, and you sell off, right? Even though the initial and original use for it is as a means of exchange, right? A digital means of exchange, right? But it has inherited becoming an investment asset. So SEC is saying, look, we need to be able to draw the lines, and we need to be able to have control on who creates and manage investment assets. So for now, it's early days, like I say, how this whole thing is going to play out. So I think it's some of the things I'm also going to be touching in the session I'm going to have on April 8th, right? And have some of the top players in that space as part of that session. But these are early days, and we're really looking at how they are really going to interpret these guidelines and this framework, right? How the letters and the spirit of it is going to really be communicated to the industry. So let's see how it plays out over the next couple of weeks. I think we'll start to get a sense of where we are going with it.
All right.
Oh,
Thank
all
you.
right. Thank you so much, Mr. George. That's super helpful. That's super clear. Thank you. I really understand that now. Uh okay. Thank you. Thank you again. If the event holds, so I don't know if you saw my message. I'm just putting myself out there. I would like to attend and everything to be wonderful. Okay. Yeah, that's it. Thank you.
Thank you so much,
Yeah, you're
Mr.
welcome. You're welcome. I think I will engage with our gypsy people to also share that event registration once I put it out. Yeah, don't worry.
All right.
We'll
Thank
communicate
you so
that.
much, George. Thank you so much, Mr. George. We really look forward to that. And we hope all mentees on the call will be able to take advantage of the opportunity to be a part of that. So we're still taking questions, right? But before we take more questions, I want to ask if Mr. Max is now with us.
Yes, I am. Thank you. I was enjoying Mr. George's insights. That's why I didn't want to interrupt earlier. Thank you so much, Mr. George, for bringing those very deep, from a very practical industry perspective. So I'll just add a few things about the presentations. So for both groups, I commend them. I think you guys did a very excellent job. I particularly liked that your presentations were very, they really covered a lot of ground, but yet you were able to put them in very concise terms. So for group one of the thoughts I just want to add to your presentation is that in addition to smart contracts, we now have something that is brewing. It's not yet had a breakthrough yet, but we are hoping soon we'll have a breakthrough on it and it would also become mainstream. So smart contracts themselves have a limitation. Mr. George did a great job in describing smart contracts, and he used the word self-executory. So one of the powers of smart contracts is the fact that they are self-executory. So it takes that human discretion element out of the way, and all that dispute that can arise from subjective human interpretation and all of that. So largely, smart contracts are objective. But what you need to understand about that is that smart contracts are really computer codes that simply execute based on preset criteria. So it means that for a smart contract to work, those criteria have to be preloaded before the transaction occurs, essentially, before the code executes. So what that means is, Mr. George gave a wonderful example of saying, for instance, with JIIPCC now, you can enter into a smart contract JIIPCC that says maybe the JIIPCC sets up a system which I know Zoom has, that ensures that you are in class or you deliver the class, and after the presentation is done, after 2 or 3 hours, and the Zoom, maybe the JIIPCC platform has the API with Zoom, and Zoom is able to transmit data that shows that indeed Mr. George attended the class, he delivered his lecture and all of that, and instantly the payment, and then the same API goes to JIIPCC's, it's connected to JIIPCC's bank account. Instantly takes the money from JIIPCC's bank account and credits Mr. George's bank account. So you can see that essentially is a self-executive contract. So nobody needs to do anything more. All you have to do is show up, do your presentation, and instantly the payment system back end of it is automated, including the verification that you actually delivered on your mandate. So that's essentially how smart contracts work. But now they have a limitation, because more often than not, we all know that in human interaction, things are usually more complicated. Things are rarely that straightforward. So which is why we ultimately end up with legal contracts with all the jargons and the legalese, because the legal contract is simply trying to say, look, we are contracting today in 2025. This contract is executed and maybe completed in 2027. So we are just trying to imagine what are all the possible things that could go wrong between now and 2027, and we're trying to put them into a contract. So that's why contracts become very complicated. So for instance, in a lending transaction, for instance, yes, you're lending a person a 100 million, you're expecting to pay at 14% interest per annum, you're expecting to pay at so and such a time. But between now and then, a lot of things will happen. There could, for instance, be maybe the project site is shut down because there has been a force majeure event, workers have gone on strike, or a pandemic has been declared, everybody has to stop work and all of that. And then suddenly the project is now running into all kinds of issues, or the loan transaction now, the person cannot repay back because the method of repayment was proceeds from the business in question, and the business has not been able to function and all of that. So it is because of all that you now have all kinds of provisions in a legal agreement. Force majeure, you have cost overruns, project overruns, and all those kinds of things you try to factor in. So with smart contracts, it's not exactly easy for them, because smart contracts are good at execution, but they might not be so good at interpretation and at dispute resolution. So there's a new field now that is being worked on called computable contracts. So with computable contracts, what they are trying to solve for is to now have machine language, have legal contract language in machine readable format, so that machines themselves can read, can interpret, and can go on to execute contracts. So you can see that this will be a lot more robust than just regular smart contracts. So what is really stopping the breakthrough now is something, which a lot of work is going to, something called contract definition language. So a contract definition language simply is a computer coded way to express legal concepts that underlie a contract. So for instance, I mentioned the force majeure clause, for instance. So you need to find a way to represent that in code form, where the codes themselves can interact and be able to automatically interpret the contract before moving on to execution. So one area where this contract is already working gradually, even though it's just like a hybrid form of smart contracts, is in the place of insurance. So in the US, for instance, a lot of progress has been made in trying to automate insurance contracts, so that to a large extent possible, those contracts can self-execute. Simply get information from things like the sensors in the car, other Internet of Things type of connections, CCTV footage, for instance, where an accident happened and all of that, and it can put all of that together, interpret itself, and the systems speak to each other. So I have insurance with my own insurance company. The car I collided with also have insurance from insurance company. So with a computable contract now, both contracts are able to speak to each other, reach an interpretation, make a judgment, and immediately determine who between myself and the other car is at fault, and whose insurance company should bear the liability, and even go as far as determining the cost for fixing that car. So you see when people have accidents and they start arguing, oh, the headlight is going to be this amount, that amount. Okay, let's call my mechanic to come to determine. When my mechanic comes, the other person say, no, your mechanic is overbilling. Let me call my own mechanic to also determine how much it will take to fix your car and all that. So with a computable contract at that high level, the contract is able to determine all of those things, including sending requisition notices to the car manufacturers to find out the cost of the parts that are bad and all that, and determine who was at fault. And also even determine, for instance, if there's a need to reduce liability, that this person was at fault, but the other person also was at fault to an extent, and therefore will reduce what he's due to get from the insurance company by maybe 10, 20, or 25%. So you can see that if this works out, it's going to be a huge thing. So just to note that with artificial intelligence, as we call them, which is popular now. What also happened was that they made a breakthrough in one area, which is large language models. That's why we have the JIIPCCs, the JIIPCC, and all of that suddenly being in the headline. Like I tell people all the time, artificial intelligence is not new at all. In fact, as of 1987, there's a professor called Professor Richard Susskind. He wrote his PhD thesis in Oxford on artificial intelligence and the law. In fact, I also have a flyer that shows a 1987 conference that was on artificial intelligence and the law. But what just happened was that because that breakthrough didn't happen for a long time, that computers were not able to seamlessly be able to communicate in human readable language until the breakthrough with large language models done by ChatGPT. It didn't seem like anything was happening. So it's the same thing with computable contracts, because we have not been able to crack the code of contract definition language, or possibly we might need to use a different type of model to be able to get to a sustainable implementation for computable contracts. That's why it's not yet a big thing, but I encourage you, it's an area you can begin to pick up and read on, so that by the time it becomes mainstream, you already have some knowledge. The leading thought leaders on the area of computable contracts is Stanford University. So they have a program called Codex, the Future of Law program. So they have this series of programs over time. You can Google them, find Stanford University Codex. So they are doing a lot of thinking and putting a lot of research into this issue of computable contracts. And we're hoping maybe in less than 10 years, we'll have a major breakthrough. And what the implications of that for the legal industry is going to be huge, because the simple way to explain it is this, is that AI is like, teaching computers how to go through primary and secondary school, where they can now, understand and speak English language. But now, if we get computable contracts right, that will now be bringing computers to a point where it's like they have gone through university and law school, and they can now speak and think in legal terms, not just because, even though at this level, just like anybody who understands and can speak and understand English can easily read a law book and be able to give some level of explanation to what he sees there. That's how AI can, to a large extent, give answers to legal problems. But if we get computable contracts right, then computers will get to a point where not only are they just able to use natural language to understand legal concepts, they are now able to use legal understanding of terminologies to actually bring solutions. So if that happens, then it will be a big deal for the legal industry, and it will be an event that, except we use political will and other ways to control, would be on the verge of losing out as an industry to computers completely. So it's still some way out, but then it's something you should keep an eye out on. Then for Group 2's presentation, thank you for that very deep thought on scalability. Actually, that's the huge area where fintechs have problems scaling. Most fintechs start and they hit the road running immediately. So they are like the fast rabbit. But after a while, they now stop to take a rest under a tree, and the slow tortoise is able to come and overtake them. There was a time, if you remember, not barely a year or two ago, fintechs got so arrogant that hearing things like, what they call them, Flutterwave is more valuable than Zenith Bank and all of that, just because they had become unicorn and they hit a valuation. I thought, look, valuation is not bad, and I'm not saying they are not valuable, but look, my goodness, you cannot joke with the old timers. You cannot say just because Flutterwave has a valuation of $1 billion that he therefore is more valuable than Zenith Bank. Zenith Bank has real asset, as in heavy duty asset. They have branches over the 700 something local governments of Nigeria. Those assets can easily be converted to do many other things. So for instance, if the government wants to give a contract now for enrollment for a new national ID, you could easily give it to the banks. So that becomes another stream of revenue that, that their physical asset alone brings to them. So we must understand that the fact that this traditional financial institutions look like they are a little bit slow and sluggish does not mean, because it is easy enough for them to partner. And I believe somebody mentioned that you can easily partner with the fintech and replicate what a lot of these fintechs do. But for those fintechs to replicate what these guys do in terms of the regulatory cost that has gone into building the behemoth that those financial institutions are, is not exactly that easy. So fintechs need to also understand that the fact that they really race off the block so fast, shouldn't give them room to become arrogant and assume that, the traditional or the conventional guys are not at their level. So I wanted to just mention one area of scalability that most fintechs have struggled, which is actually in customer complaint management. Now, most banks battle under the weight of customer complaints. So a lot of banks, if you go and do an analysis of the business they do in those branches that they built all over the place, maybe over 50% of that business done there actually is customer complaints, and then only 50% is other things like funds transfer and all of that. So most fintechs, because they do not have that physical presence, yes, they have tried to be innovative using chatbots and other innovative ways to handle customer complaints. But if you look closely, most fintechs have struggled in that front. So I just wanted to add that one of the things that fintechs need to really watch for in scalability actually is customer complaints. The truth is that the way it works with the human psychology is that when human beings have something new, they rarely see the fault because they're just excited that I can instantly transfer money. I can instantly do this. I can check my balance. I can do all of that instantly on the go. So those early days are your honeymoon period. Customers rarely, just because of the novelty and innovation of what you are doing, they'll really not pay much attention to those nagging problems. But as time goes on and the honeymoon wears off, then people are going to begin to really pick you apart and begin to trouble you for those things that they overlooked earlier, which is what happened with many fintechs. We have seen the new banks like Kuda Bank, for instance. Those guys were off the block, they were flying and all of that. But the time has come where customers are saying, look, forget all this talk. I want to see your physical branch. We also saw, for instance, sometime last year where people went to an OP office and trashed the place because they were tired of online resolution. They wanted to see a human being, flesh and blood, resolve their complaints. So that's one area I think that fintechs need to really look at scalability. And I think with the spirit of innovation they have used, I would think one way to do that is simply to do outsourced customer complaints handling centers, where they could actually outsource those places to other businesses and just let the business create a space where people can walk in and resolve complaints. That, I believe, is one of the things that really help fintechs scale, which I think they have not paid enough attention to, and many of them are falling victim to. So, sorry, my intervention has gone on quite long. So let me pause at this point and allow the Q&A session to continue. Thank you.
All right. Thank you so much, Mr. Max, for that very wonderful insights and feedback from your end. You're able to highlight very key critical issues pertaining scalability and also a few other things as regards to contracts and the issues with smart contracts. Thank you so much, sir, for your insights. So please, do we still have more questions? We'll take one or two questions and then we'll call it a day. Do we still have more questions from the mentees? Do we still have more questions? All right. So in the absence of any question, right, I want to say a big thank you to our two mentors in today's class. That's Mr. George and also Mr. Max for such an insightful and wonderful session from their end. It was really, really nice getting to hear them share their insights into today's topic. And I really, really personally did learn a lot. Please, we would like to kindly also follow, we'll be following up with Mr. George about the events that he spoke about, and anytime it's ready, the link for registration is ready. We'll be sharing it with the group so that we can, if you can take advantage of the opportunity. So with that being said, please do not forget to share what you have learned in today's class. Do not forget to share, do not forget to fill in your attendance, right? And okay, I think I'm forgetting something. For those please of you that have lights in your background, please can you turn on your videos? My internet is not very stable, so turning on my video may be quite problematic for me for network reasons. So please, can we just have mentees turn on their videos so that we can take a quick screenshot and then call it a day? Okay. Thank you, Vanessa. Thank you, Ikena. Can we have more mentees turn on their videos, please, so that we can just have a quick screenshots? Okay. All right. So thank you everyone for your time today. Once again, a big thank you to Mr. Max and also to Mr. George for your time today and for the knowledge shared. To our mentees, please do well to kindly join in for class early on so that we can have a full class in session and our mentors can be encouraged by your numbers and by your attendance. So thank you once again. Please do enjoy the rest of your weekend and